Well, I can see all the early people coming in nice and ready for today's webinar. We'll be starting with you in just a few moments.
Good morning, everybody. Hope you're all well.
So I'm just going to give it a couple more moments for the last few people just to come through the sort of chat room part to be in. And then let's ready and start today's investment webinar for you. So first of all, just want to let you know sort of an overview of what the plan is for today and welcome you to the second of our investment webinars. We hope you find today's event enjoyable. We are looking at bringing in some face-to-face client investment webinars in the new year, and hopefully you'll feel able to attend those. But just to remind you, your microphones and cameras are switched off, so don't worry, nobody else can hear you or see you. If you've got any questions that you'd like to ask during today's webinar, please use the Q&A function at the bottom of your screen. They'll come up and then we'll either answer them straight away if it's appropriate, or we'll leave it towards the end of the presentation and answer them then. Any questions that we don't get a chance to answer during today's presentation, we'll look to follow up with you afterwards. Timings for today. I'm going to spend about 5 minutes just updating you with a few things that's been happening here at Berry and Oak that will be for a benefit for yourselves. And then we're going to be joined by Shane, the CIO of U Asset Management, who will explain what's happening with investment markets. At the end of today's event, as you come to leave, you will be prompted to complete a short survey of 4 questions, just letting us know how you found today's event and anything that you'd like to do in the future for these sort of events so that we can help provide better content that's valuable to you. But firstly, probably moving on to the most important things that we do for our clients is our regular financial planning meetings. Now, at the moment, we're doing these in a combination of either face-to-face meetings, if that's what the client would like, or by doing them over Zoom. So it's whichever is your preference we're able to do. As you can see there, we've got Diane modeling what it's like to be meeting people face-to-face in a meeting. And we've got plastic dividers up in the screens and a number of sort of COVID protocols that we follow to keep people safe on face-to-face meetings. If you want your meeting face-to-face, when we're reconfirming the meeting, just let us know and we'll let you know what all those guidelines are. If not, happy to continue doing them over Zoom and keep helping you move forward with your financial planning. In the last few months, we've also been joined by 3 new people. We've got Leah, Lily and Holly. And rather than telling you about them myself, they're just going to introduce themselves to you. So it's going to be a video playing. If you've got the option to turn your volume up, then do so.
Hello, my name's Leah Buchanan. I started Berry and Oak a couple of months ago now as the Client Relationship Manager. My role involves liaising with new clients that have just started the process with us, making sure the process runs smoothly for them, answering any questions or queries that they might have along the way. I do also attend the client meetings to take up any meeting notes and also follow up any actions that might arise from the meeting afterwards.
Hi, I'm Lily and my role at Berry and Oak is a graduate trainee. I recently graduated from Leeds Beckett University after studying business and management. I originally come from Solihull in Birmingham, but after studying in Leeds, I decided to stay. I'm currently supporting the administration team and learning all the different processes and software we use to give excellent customer service.
Hi, I'm Holly and I joined as a graduate trainee after graduating my economics and finance degree with a first. As you can probably tell from my accent, I'm originally from Liverpool. At the moment, I am preparing client files for meetings, as well as helping with the relaunch of our newsletter and our charity this year, which is Just One Tree.
Well, there you go. I think it was a nice way to introduce you to the new team members, which you'll be seeing either over Zoom or face-to-face. If I was feeling mean, I could run another video now of all the various outtakes that were done to sort of get to that short video on it from there. There was quite a few reshoots. But hopefully you found that as a bit of fun to meet the team there. Moving on from there, I just want to give one big congratulations to Sarah. And I know I'm biased, but Sarah's had a fantastic achievement in that she's recently was highly commended, i.e. a very close second, in the Women in Financial Advice Awards for 2021 as Financial Advisor of the Year for the North East. So there's some really tough competition in that sector, and we're really, really proud of Sarah getting the highly commended award. And then just briefly wanted to just point out, you may well see when you're on our website or on our social media, references to a company called Just One Tree, who are a chosen charity that we've decided to support for the rest of this year and into next year. And they, for every £1 donated, are planting trees around the world to help with the sort of changing climate. They've also got something quite unique in that they're providing significant education to schools and children about environmental issues. So if you want to find out a little bit more about what they do, there's a great blog that Holly wrote that's on our website. So please do check it out. But now I'm just going to hand over to the main event, and I'm going to ask Shane to come up and join us now. Those of you that know from before, Shane is the Chief Investment Officer for U Asset Management that used to be called Beaufort Investment. And today he's going to give us a bit of a talk on what's been happening recently in global markets, which is fair to say has been quite interesting, how the portfolios he runs have been performing, and maybe a little bit more importantly, get the old crystal ball out and what do you think might be happening next. So Shane, over to you.
Thank you, Andrew. Morning, everyone. This is the IT part, see if I can get this right. Andrew, can you see the slide there?
I can see the slide. I can also see your next slide one as well.
Okay, let's stop sharing there. I know how to solve that.
You see, it's the great thing, never work with children, IT.
Or more than one screen.
Or more than one screen.
There we go.
That looks perfect.
That looks perfect. Morning, everyone. So as Andrew said, I'm going to talk about what the current economic environment looks like and how it's sort of panned out over the last year, basically. Then we're going to look at both our short-term and long-term performance. And then, yes, dust down that crystal ball to see what's happening over the next 3 months to get us to the end of the year, but more importantly, what do the next 2 or 3 years look like? There is a slot for Q&A afterwards, but if you do have any questions, please don't hesitate to put them into the talk box, and Andrew will direct me if there's any pertinent questions at that moment in time that we're talking about. And yes, I am looking forward as well to some face-to-face seminars next year. I did have one last week, and it makes a massive difference to actually see the people whose money we've been given the privilege of looking after. So what's happening? I've got a picture here of Big Ben with scaffolding all around it, and basically that's sort of to allude to the fact that economic scaffolding still remains in place. And this is stimulus from both central banks in the form of monetary policy, as well as stimulus from governments around the world in form of fiscal stimulus. So that fiscal stimulus comes in terms of relaxation in taxation, increased unemployment benefits, and for monetary stimulus, it's the quantitative easing to make sure the system is still liquid and still works, as well as extremely low interest rates. Now we're getting to a point in time where normal activity is starting to take place and sort of take hold. So it's, will we need this scaffolding in place? And that's what's plaguing the markets at the moment. It's when this scaffolding will be taken down. So when tapering of quantitative easing will happen, and ultimately when that is finished, when interest rates may rise. Now the fly in the ointment we have at the moment is obviously inflation, and we'll come to inflation later on. There's a few slides on that topic. However, why are we even thinking about taking down this economic scaffolding that helped protect economies and companies and people's livelihoods over the past 18 months? It is because we've had a pretty good vaccination program rollout. And here's his data from our collected from our world in data. They do an extremely good job of collating lots of different data, and you can cut and splice it into whatever shape or format you wish. And here we have the share of the population of each region, each country. The darker green represents people who are fully vaccinated, that's having 2 jabs, and the lighter green is those that have had 1 jab. And you can see here, if I get my pen out, that will really help. You can see here, where's the UK? Where's the UK? There's the UK there, at around 70%. I think it's gone up in the last couple of weeks, about 72. So doing a really good job. What has massively increased over the most, I'd say the last month to 6 weeks, are places like France, Italy, Ireland, Portugal, and Spain. That core of Europe have really upgraded what they're doing from pretty much a disastrous spring and early summer to have got a lot of their population fully vaccinated. Now, the scientific community think roughly 2/3, 70%, you start to gain herd immunity from this. And of course, all of this data, all of these conclusions are based on the fact that the vaccinations still are effective against COVID and any of the new variants that might come along. So the reason people are thinking about taking scaffolding down is because a lot of people being vaccinated. However, that doesn't stop news storms and medias. And here we have a chart showing you the change in confirmed positive cases of COVID. And you can see here both the US in the light blue and the UK ticking up over the summer to reach the periods that they were back in the winter. And this is where you get this fear of the Delta variant causing another winter wave and another lockdown. That is quite right. There is a lot more cases being tested positive. However, if you add into that the number of deaths from those cases, they are significantly lower than the peaks we had towards the end of last year, showing you that, yes, the vaccines, A, hopefully stop you getting COVID in the first place, but B, if you do contract COVID, it is A, stopping you being hospitalized, and B, giving you good protection against dying as well. So we are asking a lot of our vaccines. Previous vaccines are only supposed to protect you from hospital or the serious effects, such as the flu vaccine that I've been invited to have from my GP. But we're asking them now to almost eradicate everything. So they're working extremely hard for us. So you've got this picture where the vaccines are working, that will allow, hopefully, the scaffolding to start to be taken down. Now, during this period, here has been pretty much a game of 2 halves, really, or a tale of 2 asset classes. On the one side, you've got equities, which are both the driver of returns over long-term returns and also the deliverer of risk within your portfolio. And they've done extremely well over this period, whereas bonds haven't done as well. And if you look at the Q3 data just come through, you can see here on the right, this is for bonds, the bottom 3, so global investment grade, EM debt, European government and US treasuries, pretty much 0 or negative. To get a positive return, you have to go towards the high yield end of the spectrum, which is a little bit more risky and a lot more correlated to equities. On the left-hand side, you've got the equity side, and you can see there Japan done extremely well. The resignation of Yoshida Suga as PM was a real boost to the market. The index hit their 30-year high back in early September. You can see here equities done a good job. Asia ex-Japan, probably the worst performer there, and that was because of China. China's come out this last quarter with a lot of regulation. It wants to have more common prosperity. So it's looking at companies that are arguably too profitable and putting more regulation in private education. So they're making them non-profit organizations. They're looking at tech and sort of putting more regulation and taxation on those. They don't want anything too powerful to challenge their authority, and they're looking to make sure the average Chinese person is becoming a little bit more prosperous. So yeah, the market didn't take too kindly on that, so hence why they've done particularly poorly. For year to date, you can see on the left-hand side, Europe in particular, but equities in general have done much better than bonds. So it has been pretty much a tale of two asset classes. It has been easy for us as an investment team to pick where we want to place our equities. However, with appropriately diversified portfolios, you have to have something else on the other end of the scales. And for us, bonds do make up a proportion of that. But as well as bonds, we use real assets. We're introducing commodities from the 1st of November, absolute return vehicles as well, and also some things like inflation-linked bonds within our bond makeup to protect from inflation. But I'll talk about that a little bit later. So even though equities are the only game in town, there is an acronym called TINA. There is no alternative to equities. We believe over the long term, though, you're going to be best served with an appropriate diversified portfolio. And even though we are diversified, we still have had really good returns this quarter, as well as this year. But you can't miss the headlines for inflation at the moment, whether that is through fuel, whether that's through food, or better buy your Christmas presents early. Not only has COVID affected, obviously, our health, it has affected the supply chains around the world. So you have situations where ports are closed because of breakdowns. Places like China have a very zero tolerance approach to any outbreak, so they shut the ports down. So you've got situations where ships are waiting to be unloaded, A, because ports are closed, and B, as you can, in the UK that we felt, there's not enough HGV drivers around to unload. That's meant the cost of shipping has gone up something like 500%. Reading the Financial Times last week, there was one anecdote of a person who normally spends £2,500 on a container to get their goods across from China ready for Christmas. That cost has gone up to £15,000 per container. And don't forget, those costs, if they can, are probably going to be passed on to us, the consumer. Hence why inflation is a bit of an issue at the moment. Here we have a chart of forward inflation. This is showing what inflation is expected to be in 5 years. You can see the UK at the top. Pretty much all of the things in measures here in above the 2% level, which people expect. Europe slightly below. And what that's showing us is that people expect inflation to be higher now, higher in a year or 2 years' time than it is currently now. So the big fear of inflation is out there. However, you do have the central bank saying that they expect inflation to be transitory. What do they mean by that? They expect that this current spike of inflation to dissipate over next summer. Why do they think that? Inflation is measured on a year-to-year basis. What was it in October 2020 compared to what it is now? What was the price of goods? And don't forget, last summer, pretty much everywhere was locked down. Not many people were spending. And the amount of increased savings has gone up dramatically, and demand was reduced because people were locked down. Now that's reversed. Demand has massively increased because people can go out and spend, and they've got this pent-up demand of savings to do that. So on the one hand, you've got demand artificially increased because of these additional savings and the release of lockdown, with supply have been constrained. So hence, go back to your economics, supply and demand. When you reach equilibrium, that reaches your price point. If demand increases and supply stays the same, price goes up. If demand increases and supply goes down, price goes up even more. Hence why we have this spike in inflation. From our point of view, we believe inflation is also transitory, but not as short-term as a lot of the central banks. We think this is going to be a little bit stickier than people anticipate, but not structural changes. We don't think we're going to have structurally high inflation for the next decade. We think this is probably going to hang around for maybe the next 12 or 18 months. What are we doing about it? We keep a very close eye on the inflation landscape. We have a document. If we printed it out, it'd be about that thick for our investment committee. And a lot of the things we look at are yield curves. We look at inflation rates. And what we did at the beginning of the pandemic, back in April 2020, we introduced high yield bonds when they were at the most cheapest. and also value equities. And that's done a very good cushion for both gaining good returns through the high yield bonds, and the value equities perform extremely well during more volatile times, September being a prime example. And we've also recently added in some short-dated inflation-linked bonds. People talk about all different things as hedges against inflation, but if you want to hedge against inflation, you want inflation-linked bonds. They are the perfect hedge. We've brought those into the portfolios to make sure that during tricky times, September being a perfect example, that our portfolios do extremely well. That brings us on to arguably the most important central bank around the world, which is the Federal Reserve. It's still the most influential and the largest, and can influence other central banks around the world. Now, they have their quarterly meetings where they decide on where they think long-term interest rates are going to be. And in the March 2021 meeting, as you can see here, this is their expectation for interest rates at the end of 2023. And they expect interest rates there, that blue dot is the medium, the average return. In March, they didn't expect any interest rates to the end of 2023. Roll on 3 months to their June meeting, and you can see here that expectation increased to 2 interest rate rises by the end of 2023. Now, this was mainly in order to manage expectations, and also to show that they are data sensitive on this, that if inflation is rising, they're going to act accordingly. So this was bringing forward when the central banks may act. And what we're looking here is for indications of when they were going to stop their QE program, their assets purchase program. They're currently buying 120 billion of US bonds every month. So they have to stop that first before these interest rate rises can come through. Roll forward to their September meeting. That's the one on the right. And unfortunately for me, they changed the font and the layout, so it doesn't look as pretty as it did in the other one. And you can see here, interest rate expectations for 2023 have gone up even further, showing you that move in the summer from June to September. Inflation has really gripped hold. So they're expecting, majority of the committee are expecting rate hikes in 2023, and they're expecting the first rate hike potentially in 2022. So this is where we had the roadmap from the global financial crisis, and we're going to talk about that quite a bit going forward, because markets and policymakers like nothing more than something in the past to give them indication of how they should react now. And we have the global financial crisis. Now, that was 2007, 2008. It took a long time to eradicate ourselves away from that crisis. New things were added in. And the reason why we had such a short downturn for COVID, it was only 16 trading days from the height on the February the 19th to the trough on March the 23rd, was because central banks and governments knew how to react. They brought in quantitative easing really early. They brought in low interest rates. They brought in increased unemployment benefits. They brought in tax breaks. They brought in business loans to make sure the economies would not falter and suffer. And they did it quickly, and they threw a lot of money on it. So it was a huge amount of money, and they did it quickly, and that was good. What we have now is the other end of that, where we're arguably out of these emergency conditions, and they need to start rewinding those conditions. And that's where we look at the global financial crisis and how they started tapering their own balance sheet back in 2013. Now, the first thing they did, they made a mistake in 2013. They announced it as quite a surprise. So we've had central banks saying for a long time now, we will let you know when we're starting tapering. We need these conditions to be in place. We need unemployment to drop, particularly in the US, and we need to see inflation rise. Well, they've both of those measures already. So in this meeting in September, Jerome Powell came out and said, yes, we are reaching the conditions for that. All we need is a reasonable unemployment number coming out. That came out last week. It wasn't as good as people expected, but it probably wasn't sufficient to stop them announcing when tapering will start. Now, their next meeting is November, so we expect tapering to start in November for the Federal Reserve. Also, they've also told us when it's going to end. So they expect it to end in the summer. So let's say June, that time, which then gives them enough time, if need be, potentially start interest rates by the end of 2022. So that sort of maps out brilliantly. It's managing expectation, it's trying to avoid a taper tantrum within the markets. So for us going forward, it's still about COVID, even though that is under control. It can still upset the apple cart. If we get a variant that doesn't behave against the vaccine, that then everything goes back to square zero and we end up with more economic stimulus. And we drag this out a little bit further with even more increased unintended consequences. Economic stimulus is about when they're going to reduce that. We can see that already. Interestingly, our own Bank of England in December, they finished their quantitative easing program. And that's why there's hints from the Bank of England that there might be an interest rate rise before the end of the year. It was likely to be February for the Bank of England, a rise of 0.15% to bring it up to a quarter. But there is an opportunity or a likelihood it might be December. So keep a close eye on that. If you've not read our weekly blog from yesterday, we sort of talk about that quite a bit. But it's inflation. We need to keep a close eye on inflation because that is the gauge to see how aggressive or how subtle policymakers can be. Now, at this moment, we feel the biggest risk is policy mistake. This is governments and central banks either pressing the accelerator too hard or pressing the brake too hard or just not doing sufficient for the current conditions in place. Arguably, the way to combat COVID pandemic crisis was easier. Getting out of it's going to need a little bit more finesse and a little bit trickiness. So that's our biggest concern at the moment, is that at this moment in time, the risk of a policy mistake is as high as it's ever been. So that's the environment we have at the moment. How has that affected the portfolios? We're going to show you how it did the last quarter and the year. So here we have the active portfolios. You can see here the last quarter was positive, which was good, better than our peer group, who had an absolute terrible September. Our September was roughly flat, but we did a hell of a lot better than our competitors because the pressures from inflation, the pressures from overseas regulation through China, the pressures of supply chains really hit a lot of the equity markets. And with our balance of our portfolios, with our value equities and with our inflation-linked bonds, we held up particularly well, which was good. In the same manner, we held up particularly well in February 2020 when the COVID conditions hit. On the right, we have our year-to-date chart, and you can see here, the high-risk portfolios, nearer high single digits, which is fantastic, but all the portfolios in positive return. Obviously, the more risk you take, the more equity content you have, the more returns you've had in this situation. So yeah, we're really pleased, really pleased. We're going to take you through our longer term numbers later on. And a very similar pattern for our passive range. Passive range didn't do quite as well in Q3, but has had a similar pattern for the year to date as well. So yeah, we're really pleased with how we're doing it. It's about making solid, robust investment decisions, long-term decisions, rather than sort of trying to whipsaw through these markets. You do need to have a longer-term view. Obviously, if you look at Q3 here, year to date, we started the year with a lot of, I call it Grand Old Duke of York, marched them up to the top of a hill and marched them back down again. And it's at those moments in time you have to make sure you've got robust processes, that you don't make knee-jerk reactions. And obviously, from the end of that sort of first couple of months, the markets recover quite nicely, but in waves. So, yep, we think there's going to be positive end to the year. We think the next couple of years are going to be positive, but with volatility, and I'll come on to that later. Okay, long-term performance over 1, 3, and 5 years. So we wanted to break them down into these periods. We've looked at them, in the past since launch, and don't get me wrong, the figures look exceptionally good. We've been running the portfolios now almost 17 years, and I think portfolio 10 is close to 400% return. But obviously, those numbers can create unreasonable expectations, and not everyone's been invested 17 years. So this is why we look at 1, 3, and 5 years returns. So here's the active range over 1 year. And you can see here quite nicely that the more risk you take, the more return. And you can see here the dip we had in November. Why do we have that dip? That was just as the sort of winter wave was coming through. People thought there was never going to be a vaccine. And then on the 9th of November, Pfizer and biotech announced that they had a vaccine, and we had a good rally. We map that against cash, which is in green. You can see that very low slither there in green. Inflation, which is the amber bar. You can see that inflation almost up to 5% over that period. And this is the FTSE 100. And the FTSE 100 doing exceptionally well over that 12-month period. Now, when we take it over a bit longer period, you can see it's not had a great time, but it started from extremely low base. So all the portfolios here beating cash, and all the portfolios apart from portfolio one beating inflation, which is really key. Look at 3 years, you can see here the COVID drop significantly. Don't forget markets dropped significantly more than that. And you can also see here the drop we had in Q4 18. This is where the Federal Reserve announced they wanted even more interest rate rises. Now that spooked the markets because the main cause of recessions are central banks increasing interest rates too high too quickly, and the market thought that was going to happen. So it took Jerome Powell until the 22nd of December here to announce that they wouldn't be making any more interest rate rises in 2019, and the market liked that news and recovered quite nicely. Now we expected that to continue forward if it wasn't for COVID, but if you can see here, that same trend has pretty much continued as if COVID hadn't existed. To compare the portfolio's performance over 3 years, you can see here cash in green. And you can see here the FTSE 100 hasn't beaten inflation over the last 3 years. So it's had a good 12 months, but the previous 2 years have been pretty shocking for the UK. That's a combination of COVID and a combination of Brexit as well, and a depreciation of sterling. It's all hit at the same time. We've had a really good 12 months for the UK, and that's why we went overweight UK equities in February this year. Finally, 5 years. This is sort of our litmus test. We always like to say, give us 5 years to see what returns we're getting here. You can see here some excellent returns. And again, more risk you take, the better return there. You know, COVID, a big drop down, but if you stay invested, it didn't take long for you to recover to where you were, which is the key. And all the portfolios beating cash, all the portfolios, again, portfolio one beating inflation, and the higher risk portfolios, even the medium ones, we call these the medium. That's the medium. And the ones to the right, the higher risk, beating inflation, beating FTSE 100 as well. So we've had a really good period, and that's down to clients trusting us, what we're doing, and hopefully reassure them that our long-term performance is good. It's also down to making sure we have robust processes and believe in what we do. It's very similar pattern for enhanced passive, slightly underperformed active, but not by much. It's been a really good period for both investment styles. Again, you can see here the 3 years performance and the Q4 performance there. And again, all the portfolios get outperforming cash, inflation, and the FTSE 100. And again, those 5-year numbers are probably about 10% lower than active, but still really good returns. And again, portfolios 4 and above outperforming all the metrics. So we're really pleased with the performance at this moment in time. So that's telling you everything we know, what's happened. This is where we have to dust down the crystal ball. And for us, it's about reassurance at this moment in time. We think the markets are well placed to continue to grow over the next couple of years. That's going to be a headwind of still easy monetary conditions. Don't forget, even though they're tapering QE, we still are in easy monetary conditions, and interest rates are extremely low. If you go back to 2017, which was one of the best years we've ever had, that was in a backdrop of QE finishing and interest rate rises, regular interest rate rises. So it is a good environment for this to happen. Yes, it will be volatile, but it's still a good environment. What we have, though, is sort of a changing of the baton here, is following the plans of both the global financial crisis and the dot-com. Here we have a measure of investment, business investment, and this is where we expect the government investment to roll off and business investment to pick up, and this is what the forecast is here. So don't expect markets to falter just because they've been extremely good recently. I think it's 400 days without a 10% correction, which sounds a lot, but there's a lot more records in there that surpassed even those dates. So just because we haven't had a correction for such a long period of time doesn't mean we're going to. It does mean there could be volatility. It does mean at the start of tapering, there might be a few jitters, but we think there's a positive outlook for 2022 and 2023. This brings us to our final slide here, where we have this sort of plateauing within markets at this moment, and that's just natural because this green line here represents an average of all the rallies we've had since 1966, and there's always a pause for breath when we go from early cycle, which is the emergency monetary conditions, that easy monetary policy, low interest rates, and a lot of government spending, to a period of consolidation where we start to consider when those easy conditions are going to reduce down and governments are going to sort of slightly pull back. But that doesn't mean we're not going to get another good return here. And we think with demand being high, we think with additional savings from consumers, with COVID under control, and with inflation not structurally higher, and will be coming down over the period towards the end of 2022, we think this is a really good outlook. So from our point of view, the biggest risk on the horizon for us, it's here. Policy mistakes. Yes, we have to be concerned about inflation. That's something we're going to measure because that really affects the basket of bonds and real assets and absolute return more than it does equities. Yes, we have to be worried about infections. So we have to keep an eye on the COVID rates and make sure that they don't spike up and the deaths don't spike up. And yes, we have to make sure about unemployment continues to go down. The furloughing scheme is ending. The unemployment benefits in the US are going back to normal. So we'd expect to see unemployment coming down. So the big thing for us is policy mistakes. Making sure that Joe Biden can get this fiscal cliff through to make sure there's enough money in place. Making sure Jerome Powell doesn't make any mistakes with two new members of the Federal Reserve coming in and his own tenure up for renewal in February. So will he get a new place? If we get a new head of the Federal Reserve, gosh, policy mistakes go up even further there because we're not going to know how they're going to react. And Boris Johnson as well, how he's handling things like the supply shortages in the UK and the risk of Christmas being cancelled, not because of another lockdown, because we're not going to be able to get the goods and toys and, I don't know, maple glazed dates that we're able to get. So there's a lot of pressure on these policymakers, and it's that's what we're keeping a close eye on at this moment. Really important slide. You need to make sure you read that. And yeah, thank you for listening. I'm going to turn the slide off now so you can just see mine and Andrew's faces. Andrew, have we had any questions?
Yeah, we've had a few questions. So thank you for those people that have been putting questions into the Q&A chat. And if anybody else has got any questions that they would like to pose to either myself or Shane, do put them into the Q&A that you'll see at the bottom of your screen. But one of the ones that's come through is bonds are not attractive. You don't get any interest on cash, and property funds are generally being sort of wound up now. So what else is available then other than stocks and shares?
No, that's a really good question. So it's you know, the easier part of our role, of our job over the last 18 months, arguably 2 years, has been filling up the side of the scales where you have equities. And you know, we're sport for choice. We like Japanese equities, like UK equities. We're underweight UK and not underweight Europe at the moment. But the other side, where traditionally you would have held bonds, that's trickier. So you've got extremely low yields. Government bonds, I think something like 1.5% for 30 years. So if you invest in those, you're going to get a return of 1.5% for the next 30 years. Inflation is going to halve your capital at that level. As you say, interest rates are extremely low, so cash isn't really viable. arguably could be viable for protecting on the downside, but then with inflation high, you're going to ravage your real return in cash. Property has had a really tough time, commercial property. You've got companies looking to rent not as many floors, with people still working remotely. And when they do work in the office, it tends to be more of a hot desk environment. So where do we look for? We still look for bonds. There's still some areas in bonds that are doing really well. Emerging market debt is really attractive at the moment. High yield bonds still looking really attractive. Some investment grade, you have to be really picky where you want to be investment grade. This is where I think active in fixed income in bonds has slightly outperformed passive, because passive will just buy the largest and arguably the most indebted areas, whereas active managers can pick and choose where they want for those. We also like the investment linked, inflation linked bonds. So there's still areas in bonds that look attractive, but not as a whole basket. Then we look at the absolute return areas. So these are the funds that are going to try and produce a positive return in all markets. That is fraught with a lot of good, bad, and ugly funds in there. So we like Sanland's multi-strategy fund that squeezes out moderate returns over those periods without taking too much risk. We like Allianz fixed income macro that looks to trade a lot on the currency side on there. And we like Fulcrum's equity market neutral, which looks to do sort of a derivative play. Those three blended together give us a really good return. And as I said, on the 1st November, we're going to be introducing PIMCO's commodity fund, which is a basket of the main commodities out there. Yeah. So it's hard, Andrew. It's trying to find something not necessarily going to give you a really good return, because I think that's almost nigh impossible on that side of the scales, but something that's correlated lowly to equities. So when equities behave differently, so when equities go down, you want this side of the scales to perform differently and provide that cushion. And September was the proof of the pudding in that for us.
Definitely. And I think we're finding that on the financial planning side, that normally we would recommend people keep a certain amount of money back in cash for what they're drawing from either their income or fallback savings for the unexpected. And pressure is coming to bear on those that, where the amount we would normally recommend in cash is being sort of questioned, because it's just not going to earn any money and it's going to lose money to inflation. And there is a temptation for investors to invest too much and not leave enough in cash because they're disappointed by the returns that cash is getting. But we have to be careful that we keep money back in cash for a reason, which is to protect and have it available when you suddenly come to draw it. And if you needed to draw your money in March or April last year and it was all invested, then it would have been a very difficult time.
Yes.
15-20% drop. So it's certainly something that we're very aware of on the financial planning side, of getting that balance right between what's kept back free and available and what's actually invested from there.
It is difficult, Andrew, and I think that's why it's important to have a really good financial planner, because they can see the woods for the trees and not say, look, your cash is there for short-term income measures, for emergency needs, not necessarily for that return. Yes, you might be able to get reasonable return, reasonable probably thing. I think my father was complaining the other day. I think his year's interest was something like £9.
As much as that.
Yeah, exactly. I said, that's good.
You mentioned about the commodity fund, which is probably leads on to another question that I love. This as a question. Should I buy gold? And that's not somebody thinking that they just want to treat their wife for something new for Christmas. I think they mean that as an investment decision.
Yeah. No, it's please tell me there's no Bitcoin questions.
Not yet.
Good.
We had those last time.
Gold traditionally has been used as a hedge against higher inflation. It's not the perfect hedge by any stretch of the imagination, because it's almost used as like a pseudo currency. For us, in our commodity basket, I think gold represents a very small portion. They're looking at things more like copper and different soft metals and some of the softer commodities such as wheat and cocoa and things like that. But gold in itself, I think it's one of those. It's if people want peace of mind and reassurance, gold isn't bad. I think the only downside you really have to be careful of is the spread on gold is absolutely huge. Absolutely huge. So if you wanted to buy a small bar and pop it under the bed or in the safe or wherever you want to keep it, the cost of buying and then what it's worth immediately selling, it is a huge spread. So you just have to be aware of, if you're buying things like gold, you probably need to think really long term on that. I think the bottom of the market was probably about 2 years ago. It's still reasonably priced. I wouldn't say it's expensive at this moment in time. But if clients are looking to buy gold, yes, it could act differently to equities or it could act differently to bonds. But if you're buying, probably want to buy physical. And if you're buying physical, just be aware of the spread's huge. A bit like when you buy your holiday currency, you buy at €1 and you sell at 80 cents. Just be aware there's gold tends to have a huge spread. The more you buy, the better. But I don't think many people can afford a kilo bar of gold.
Yeah. Okay. Another question then for you, Shane. You obviously run a range of active portfolios and the enhanced passive.
Yeah.
And I know there's always a lot of debate in the press about one method is better than the other and vice versa and everything. I've always been in the camp that over time, I think they do about the same. There are times when one will be better than the other. And I think pre the sort of COVID fall of last year, it was fair to say probably the enhanced passive was outperforming the active.
Yeah.
But it's been a total reversal during the last 12, 18 months when actives really come back to the fore and being able to make those specific decisions. And then when you look back over 5 or 10 years, they're both about the same.
There's not much in it. No. For me, it's what you had probably after the GFC, the global financial crisis back in 2007, 2008, was an environment where everything was pretty much going up in a straight line. So if you're an active manager, there's not much opportunity to add value. And that's where you suddenly had this period where enhanced passive did really, really well. It needed a more volatile environment for active to come through. And then you saw the benefits of holding active. But as you say, over a whole cycle, there's not much to choose between it. We think as a team, because we have a product where you can blend the both. So as a team at the moment, we're favouring active over passive. But roll forward to something like, end of 2022, beginning of 2023, we're going to have a similar environment to say 2017, 2018. That was an environment where passive did really well. So, even though active's, in the sunshine now, we think enhanced passive will have its day as well. And then obviously we'll think active will come back as well. So it's a difficult one, Andrew. I wouldn't advocate trying to jump between the two because more often than not, you might pick the wrong sides. But yeah, there's not much between it. I think clients are either active in their beliefs or they prefer in the passive role. But either over a full cycle should provide you net of returns, net of costs, a similar return.
Yeah. Okay, great. And then another sort of very topical question: what sort of the effect of the sort of lack of lorry drivers? What might that have on the UK stock market?
Wow, that's a really good question. Probably not as much as you might think. I think it would probably drive sentiment more than anything. And in the short term, sentiment is a big consideration for the way markets behave. There's a lovely quote saying, in the short term, markets are voting machines, so it's driven by sentiment, and in the long term, they're weighing machines. So fundamentals decide on what the value is going to be. Mm-hmm. So in the short term, the lack of HGV drivers, supply chains, people might look at the UK and go, actually, this is not a place where I want to be invested. I want to be invested in the US, who aren't having any of these issues. They are, but it's not as well publicized. So you might see flow coming out. Now, that doesn't mean UK companies are bad. There's, the value side of the UK, those companies that we consider to be on the value side are doing extremely well at the moment. And we think they will do well. So it's that sort of Ronseal moment where you have to look under the bonnet, open the tin to see what's inside and say, actually, the UK fundamentally shouldn't be affected at all by any of these shortages. However, sentiment could be a big driver of making assets leave.
Okay, and probably in a similar bit, and something that I've advocated to our clients for a very long time, is really not to pay too much attention to what they read in the press, because there is what the press like to do, and maybe the UK is worse than most places in the world, where we seem to over centralize things and make much more of them than they really are. But actually, when you actually look under the hood, there's not much a problem. Or actually, the papers are screaming that the market's fallen, when actually reality is investments have gone up. When people look at it, and they're often surprised when they check their own valuations to find actually it's doing quite well. That's not what BBC News said. But
no, you are spot on. I think I wrote in January 2020 about media being the main culprit of investors' short-term horizons. And as you're right, they're so sensationalized, so emotive, the language to get you to buy the newspaper, to click on that link to read that story, when half the time the story doesn't actually bear any resemblance to the headline. So yeah, it's I think one of the challenges that I like to take on is making sure clients get a better source of information. So the quarterly review, which I think is due to be issued today, so keep an eye, Andrew, for your inbox, hopefully provides a clearer, fairer view of what's going on in the world, rather than sensationalizing it. Because what happens is, if you keep sensationalizing everything, it loses its impact. So when there is something significant out there that people should be concerned about, they don't act. And if crumbs, I remember reading one of the headlines back in March last year, and the sentence was, it's about being people, lockdown, and the people was, we are be given a life sentence, our life is over. And I'm like, gee whiz, talk about really frightening and making it seem dreadful, when in reality, when you look back, yes, these measures had to be put in place to be in the position where we are today. So yeah, we try and cut through all of that media sensationalism. Things like this massively help. I think face-to-face massively help to give clients a better opportunity to hear it from our perspective, and also to ask questions as well. You can't ask the newspaper questions on that. We're watching Gogglebox for our sins, and it was where Andrew Marr is interviewing Boris Johnson and Keir Starmer. My son was getting quite het up, and I was like, that's Andrew Marr's job, to ask arguably the emotive question, but not the right question.
Yeah,
because they want ratings. But yeah, you're right, Andrew. I think the media here in the UK is probably one of the worst for doing that.
And I think that was probably born in the recent sort of petrol issue.
Yeah.
Lack of petrol, where in reality there wasn't a lack of petrol, and people wouldn't have bothered going to the petrol station if it hadn't been reported as it was. And reality was, it wasn't really a problem. It blew over in a few days, and wouldn't have even happened if people hadn't charged out, filling tankers in the back of the boot.
You know what? You're spot on, and I think that's a really good analogy as well. Because when individually people are sensible, collectively you can get spooked. And I think it took me real discipline to not fill the car up, because I'm not going anywhere. I don't need to fill the car up. But you see these queues, and you're like, your behavioral impulses make you want to do it. And it's the same with investing. If you see everyone sort of cashing in when the markets are dropping, you tend to think, oh my gosh, am I being silly staying invested? And Andrew, we've shown you many empirical evidence of staying invested is the best thing you can do. But yeah, the fuel will be a good analogy for the future to say, look, you didn't have to panic buy. Yeah, it was a short-term blip, and it's the same with investing.
Brilliant. Well, thank you. Well, I'll just probably sort of finish on just with Jane. You mentioned about the quarterly review document. It will be getting emailed out. If it's not today, it will be tomorrow. I've already had a good look at it and a good read through there. And I do recommend that you do take the chance to read it. It is very good. It is very informative. And I think, it's an easy read. It's not full of jargon that's hard to understand. And it'll just give you a little bit more context to the things that Shane have sort of spoken to you about today. So just a couple of things, just to sort of finish off, if I may. I'd just like to thank you very much for sort of attending today's webinar. I hope you found it really useful. Obviously, want to thank Shane for his time. Really, really good, informative presentation you've delivered there. As you exit the webinar and sort of click to leave, it will prompt you with 4 questions that we'd be very grateful if you could fill in. Just letting us know what you found valuable from today, anything that you would recommend that we changed, and any ideas that you'd like for future webinars, because it's your thoughts, your views. We put these on for your benefit, and you letting us know what you would like. That helps us do them. And then I have to give my very important slide next on it from there, which unfortunately isn't the wonderful picture that the team chose, but it's the words on it from there that I'm sure you've all read many, many times before. So from me, and I'd like to say thank you very much. Shane, Sarah.
Thank you. It was thoroughly enjoyable. I look forward to the next one, hopefully face to face. Thank you, everyone.
Thank you for joining us, and we'll speak to you all soon.